All right, let's get right into today's explainer. We are unpacking what is easily one of the most fascinating and honestly kind of confusing stories in the AI infrastructure space right now, Western Digital. We're looking at a bizarre market puzzle where extraordinary blockbuster business performance somehow slammed headfirst into extreme market volatility. So I'm going to guide you through the data, the market reactions, and the underlying technology roadmaps so we can clearly understand exactly what is happening in the data storage industry.
Okay, let's dive into this. Picture this for a second. How does a company post absolute record earnings, completely crush analyst expectations across the board, and still manage to lose nearly 20% of its value in just 24 hours? I mean, it's a paradox that completely defies standard market logic, right? To actually understand this disconnect, we have to look way past a single earnings report and focus on the massive structural changes happening within the company itself and really the broader artificial intelligence economy.
So, Section 1, the new Western Digital, a pure-play HDD powerhouse. Basically, following the spin-off of its flash memory business, the company is now perfectly positioned as the absolute cost-effective backbone of the cloud. Let's look at the numbers.
Just look at these fiscal fourth quarter results from August 2026. The numbers are frankly spectacular. Revenue hit $3.75 billion. Earnings per share more than doubled year over year, completely blowing past consensus estimates. And check out that gross margin, a massive 1,310 basis point improvement. By literally every traditional metric, this was an absolute home run for them.
But here is the stark reality, minus 19.1%. Despite those blowout numbers, the stock just crashed. We're talking plummeting from an all-time high of $799 all the way down to about $420 in a matter of weeks. Crazy, right?
So what exactly happened here? Well, it really boils down to market psychology. This was the ultimate, classic, buy the rumor, sell the news scenario. The expectations leading up to this earnings call were just so euphoric that unless Western Digital delivered some sort of reality-bending forecast, a sell-off was pretty much inevitable. The market was basically hunting for any excuse to normalize.
As one portfolio manager succinctly put it, the recent volatility appears disconnected from any material change in long-term fundamentals. In short, the market was throwing a bit of a short-term tantrum, completely ignoring the fact that Western Digital's underlying business is actually incredibly robust.
Moving to Section 2, the AI storage supercycle. To really grasp why their long-term outlook is so solid, consider this wild fact. Western Digital's entire hard drive capacity for calendar year 2026 is already fully booked. We're talking long-term hyperscaler agreements, locking in demand all the way out to 2031.
And this massive demand wave really relies on three main pillars. First up, training, refining those massive large language models we hear so much about. Second is inferencing. Basically, every single time you generate an AI response, that output needs permanent storage. And third, physical AI. Think about autonomous vehicles and robotics. They're generating terabytes upon terabytes of video data every single second they operate. This is exactly why management expects storage demand to grow by more than 25% annually.
What the data brilliantly illustrates here is a classic, massive structural gap. Nearline HDD demand is just surging, up to 40 to 50% annually. But supply? It's trailing behind at only 30 to 35%. Morgan Stanley is actually projecting a shortfall of up to 400 exabytes by 2028. To put that in perspective, for Western Digital, this kind of scarcity equals one very important thing: immense pricing power.
On to Section 3, the technology roadmap. Because obviously, capturing this supercycle requires continuous innovation, and Western Digital is aggressively stretching their drive capacities to 100 terabytes and beyond.
Let's move to how this builds out practically. They're securing this huge advantage through two advanced magnetic recording tracks. First, there's ePMR, which pushes drives into the 40 to 60 terabyte range by late 2026. And then comes HAMR technology in 2027, which gives them a clear path to 50, 70, and eventually over 100 terabyte drives by 2029. It's actually a beautiful dynamic. Higher capacity drives allow them to charge more per terabyte while simultaneously slashing their own manufacturing costs.
But let's get into Section 4, risks and rewards. Because despite the phenomenal earnings and this massive structural supercycle, relying on a business at this insane scale comes with some very specific, substantial risks.
Now, what's really interesting about their revenue is the sheer customer concentration. In fiscal 2026, a staggering 89% of their revenue came strictly from cloud customers. And it gets even wilder. Just 3 individual tech giants drove more than 30% of their total revenue. That leaves Western Digital heavily dependent on the purchasing whims of a very small group of buyers.
On top of that, there are pricing and tech transition risks to consider. Sure, their capacity is booked out through 2031, but the actual pricing for those later years, like 2029 to 2031, is still actively being negotiated. Plus, transitioning to that new HAMR technology, that's likely going to bring higher upfront costs, which could definitely squeeze their profit margins in the near term.
So the crucial point here is the multiple, 27x. After a ridiculous 625% surge leading into the summer, the stock was trading at 27 times forward earnings. And at that sky-high valuation, priced for absolute perfection, there is literally zero room for error. Any slight delay, any tough negotiation, and it triggers massive volatility, which is exactly what we just saw happen.
Yep, through all of this, management is absolutely putting their money where their mouth is. They are incredibly confident in their cash generation. They launched a massive $4 billion share buyback authorization and hiked their quarterly dividend by 20%. To date, they've already returned $2.2 billion directly to shareholders through these buybacks and dividends.
Which leaves us with a pivotal question. Is the market demanding perfection, or are they completely missing the supercycle? Look, Western Digital sits right at the exact intersection of explosive AI demand and severe supply constraints. Yet those sky-high valuations and extreme customer concentration prove that short-term market mechanics can absolutely still punish long-term fundamentals. So I'll leave it to you to decide. Was this 20% crash a completely justified reality check, or just a short-sighted panic in the face of a massive, multi-year supercycle?